Hey guys, John deRoulet, Head of Revenue Management Education here at Wheelhouse, and today we're going to do a data deep dive into Ookaloosa Island, Fort Walton, and Navarre, Florida market data. Should be a great opportunity for us to kind of see what's going on this summer, talk a little bit about strategy, have a conversation about what I'm hearing from around kind of the country and the area, and really just make sure that we're all set up to finish out the summer strong. Before I get started today, I do want to point out something to you. We will be using Wheelhouse market data for this conversation. You'll be hearing me use a lot of terms like pace and booking window and stuff like that. If you do not have access to all of these data points for your own portfolio, you can utilize Wheelhouse's performance insights for free. It's really important for us to kind of know what's going on in the market, but the missing piece here is going to be what's going on in your portfolio. It has a huge effect on your strategy and what decisions you're going to make, because let me tell you what, there's a big difference between the market being down and you being up, and the market being up and you being down. And so having access to that data so you can kind of fill in the missing piece and see how you're doing in relation to the market is really key. Our Performance Insights tool lets you look at every group of listing in your portfolio. You can filter down into specific groups, specific buildings, specific complexes, look at historical data, and see your pacing at a glance. It's a great opportunity to use our Performance Insights. They are fully free. You do not have to Wheelhouse pricing customer. And if you'd like some training on both how to set up and use the platform and also on what processes to get the most out of it, let us know. We'll get you hooked up. All right, so the first market report I have pulled up is for Fort Walton and Ookaloosa. You can see here that Wheelhouse market reports kind of cover a broader area, but that actually makes them a really excellent way for us to see broad level trends. Wheelhouse does offer these market reports for free, so whether or not you're a Wheelhouse pricing customer, you can always look at the kind of top level trends available for any market around the world that we service. Wheelhouse does have the ability to look into more specific neighborhood data. We're not going to explore that on this call. However, if you want to explore more specific neighborhood data or draw your own specific boundaries, you can utilize Wheelhouse's sets tooling to do so, which will allow you to basically create a market report for any set of listings that you like. For now, we're going to focus here on the top level and just kind of see what's going on. So the first thing I'm going to do is I'm going to go over here to the trends section. And we're going to take a look at occupancy first. This trends view is a view I really like. One, because it gives us a really holistic view of what's going on in the market. We see the KPI for occupancy for every month of the year. We also see it year over year. And as you can see here, I've turned off 2026 and 2023 just to focus on this year and last year, but we can see multiple years of data here. It's a really great view because we can see how things have been going over the past few months. We can see what's going on in the future. And it's also really good if you need to talk to owners about performance. We all know that there's a lot of KPIs available. There can be a lot of parallelization by too much data in this space, but most people understand occupancy and understand its impact on demand. If there's less occupancy in the market, that means there's more to go around. And you can usually make a good case by starting with the occupancy and using that to communicate to people. Overall here, we can see that Fort Walton and Ookaloosa areas are doing pretty reasonably this year. Now, if you're like me, you've heard that there's a lot of pressure in the markets this year, particularly starting about spring. We started to see a lot of drops and a lot of difficulty that was occurring. It caused a lot of panicking, especially on the Panhandle. Now, how much that affected each individual market is going to be really different. We have some markets that have responded to it really well. We've had others that are starting to see more and more attrition. We also know that certain levels of international travel are really impacting specific markets. Now, that doesn't seem to be as big a deal in the Panhandle for spring and summer, but we do see, like in the Northeast, big effect on occupancy as Canadians don't travel. We see in like Miami, as international starts to drop a little bit, that there's basically not as much occupancy to go around. For you guys, when this started to happen, we were already past a lot of the snowbird season where we see a lot of those people. We're also, to some degree, those people book really far in advance. So it'll be interesting to see what the effect is. But when we look at the occupancy levels for Fort Walton and Ookaloosa, we see that generally speaking, the year has been pretty close from an occupancy perspective year over year. We do see some attrition in February, but occupancies are generally pretty low. We do see some attrition in March. Now, that's kind of the early phase of where people were starting to be concerned, but it really didn't have a major impact here in Ookaloosa, Fort Walton. We do see a little bit of a drop. However, We also know Easter was moving, and when we move over to April, we actually see that occupancy gained back. So pretty much a net even, maybe even a little bit positive between March and April in the market. Now, as we get into May, still pretty similar performance year over year. We're within a couple of percent, but there is a slight bit of attrition here. And with June just ending, we pretty much landed directly on it. So from an occupancy perspective, quite a bit of stability. We're seeing that the market is able to capture the kind of demand it had in the previous years. Now, the big question is, what does this look like looking forward, right? Pace is going to be the big piece, because when we look at July, we're well over halfway there. In fact, we're well over 2/3 of the way to where we were last year at 58% compared to 72%. So quite a bit on the books. That drops off quite a bit as we go to August, but so does the seasonality. We're maybe about 1/3 of the way there. And then as we kind of hit this shoulder season from August through October, occupancy and advanced booking are a little bit low. Now, I went ahead and calculated some of the pacing for you guys, because that pace is going to be really important. I went over here to our historical page, and I figured out using the lead time distribution chart how much was on the books last year at this time for these months. And essentially, July, August, and September are all pretty close. So July at this time last year was about 55%. So we're a little bit ahead for July, a couple points ahead, which is good considering, we have the whole month to book. It gives a little bit of room in the market. August was at 18% last year. So that one's a little bit behind, but barely behind at all. We're talking 0.2%. So pretty much right on pace. And September was at about 12%. So now that one is a little bit more behind. We see that kind of indicating that that short-term window is picking up quite a bit, but there is a little bit of trailing there. So a little bit of mixed, but generally pretty good. The fact that July is on pace year over year at a market level, and August is on pace, means that the majority of what we'll be paying attention to over the next few weeks is looking pretty good. Now, something else I like to take a look at is just to see if there's some differences in the highest performing groups here. So I'm going to click over here, and rather than look at the entirety of the market, I'm just going to look at the highest performing listings. Not too much here is different. We do see a little bit more of attrition in February. However, those occupancies are generally much higher. We do see a little bit more gain in April than what was last in March, but still a little bit of attrition in May, pretty much on spot for June, and a high occupancy on the books already for July. So that's a pretty interesting story. It seems like Fort Walton and Ookaloosa are looking pretty stable from the occupancy perspective. That's a good thing. Definitely doesn't mirror every market area in the Panhandle. Some have been under a lot more pressure, particularly in the spring. But the other thing too is that it does show that there's maybe a little bit of stabilization since the spring as well. Now, what we didn't look at here is the rate situation. Even though we're pacing on track for a good rate position, a good occupancy position this year, we do have to consider the other side, because it doesn't mean everyone's making the same amount of money. What I have here pulled up is the asking rates now. Asking rates are a good way to see kind of like what the market is doing, whereas occupancy is a good way to see kind of like how the demand is coming together. Asking rates are the averages of what is being advertised across all the channels. So that includes properties that are selling, it includes properties that remain unsold, but it's a good idea to see what is kind of going on overall. In general, we can see here that in the past, where all of the rate drops have been taken into account, the market has gotten a little bit conservative pretty much across the board, except for in April. The market hasn't been pushing this rate super hard. We do see that we don't lose a lot of ADR in March, despite Easter moving. We do see a lot of more gained back in April. So generally pretty good sign there through the spring that remained pretty stable. Now, this is where things start to get a little mismatched. In May, we saw that there was a little bit of attrition on the occupancy, but the market itself didn't really respond super well in that it was pushing rates. Now, that attrition wasn't much, so maybe that's fine. At least it was fine for most people, but some people did end up unbooked. But as we get into the summer, you see that the rate positions are actually still pretty strong across the board. June pushing the rate a little bit at a market level, and that ended up about on par. So generally pretty good. ADR position is strong, occupancy is maintaining. The thing to compare here is your own pacing. If you haven't been pacing as well, or you have some vacancy that needs to be made up, it means that you really need to watch, make sure that your pricing is maybe in line with last year. It does mean you have some room because the market is still pushing price a little bit more because that occupancy is maintaining. And you may not have to go down that far to really put yourself in a good position. If you go forward into July and August, you can see that those rates still continue to be pushed a little bit. In July, pacing is pretty much right on. It's a pretty good situation there. Whereas in August, we're basically right on too. So a lot of room for this to go either direction. It looks like, based on June, it probably might come together. But if we look back at May, we saw a little attrition there too. So could go either way. My best advice would be to make sure you're watching your pickup every single week. Make sure that you are pacing in line or even a little bit better than what you had been doing in previous years. That way, if there are any changes, you have some space to absorb it. And really make sure that you're focused on that pacing and pickup on a week-to-week basis. Small reminder, if you don't have an easy way to see your pacing and pickup, let us know. We offer our pacing and pickup tool for business intelligence for free, and we'd be happy to get you set up and teach you how to use it. But overall, it looks like things are looking pretty decent in the market. The market's able to maintain, and there is some room if you are falling behind. Now, something else here too is we did talk a little bit about how past August, the market is pacing a little bit behind. So that booking window does appear to be getting shorter. And when we look further out, August, September, October, November, those rate positions are quite a bit higher in the market. It means that the market really isn't optimizing too much. It's not taking what it learned and what it had to do in the spring and applying it to the fall. And that might mean for you an opportunity. If you're trailing or you just want to try to take more market share, if you spend a little time to focus on getting these rates in line, making them competitive for the consumer, you may be able to actually take market share by booking early. And especially if you do this in properties that, don't have a history of just being totally slammed and having the customer book whatever you want it to, you're not really giving anything up or displacing revenue. And all you have to do is kind of undercut the market a little bit to put your position in line. The last thing I want to check here is just what the high performance group is doing. So I've switched this to the high performance group, and there is a little bit of a different trend in pricing. So we didn't see too much of a different trend in occupancy other than the fact that occupancies are generally higher, but we do see a slight difference in trend from the pricing perspective. The main one being June and July in particular, they're not pushing the rate as much. So when I talked about looking into the fall, and potentially just adjusting your rate, you don't have to go all the way down to last year, but you just need to undercut the market a little bit. You see the highest performers doing that. They're being pretty conservative year over year in terms of rate increases to what they're posting versus what they did last year. They're not trying to push the ADR that much. They're not taking near as much risk. However, we do still see from September and on that starts to deviate. So really indicating that people aren't looking too far out. They're really not looking out much past July or past August. And again, that opportunity still exists. It's supported by the idea that the top performing listings are kind of doing that. They're keeping their rates a little bit more conservative. They're not trying to push it. They're doing it a little bit further out, right? They're doing it already in the summer. But that doesn't happen a ton out in the fall, which means there's a lot of opportunity for people to try to take the market share that is there by just pricing a little bit more effectively for the customer. All right, so that was Fort Walton and Ookaloosa. Let's take a look at Navarre's market report next. So I have the market report pulled up here. We're going to hop over to the trends page and take a look at adjusted occupancy first. I'm going to flip off 2023 and 2026 so we can just focus on year over year. And what we can see here is, obviously seasonality and things are going to be pretty similar, but we do see some slight differences, right? April didn't make up quite as much occupancy as what was lost in March. When we looked at Fort Walton and Ookaloosa Island, that April occupancy made up for the loss in March. Here, it looks like there's just a little bit of attrition. So when I talked about some markets are under a little bit more pressure, the drop in March was much larger in Navarre. And what was gained back in April was much smaller. So you actually see a little bit of a loss. Whereas Fort Walton, Ookaloosa, you're saying like, hey, the market's actually remaining pretty stable. Here, when we look at February, March, April, and May, we're seeing a net loss in occupancy. We're seeing a drop. That means things are more competitive and there's less demand to go around. That continues all the way into June. So when we look at June, we see, again, another small loss in occupancy. So overall, pretty much every month except for April is down a bit this year in Navarre. So a little bit more pressure here, a little bit more competition for the people in the market. When we look forward into July and August, we're still in a pretty strong occupancy position. We're over 2/3 of the way there with 30 days left to go in July at 59, almost 60% compared to 76%. For August, we have a little bit on the books, maybe a little less than a third at 17.3 compared to 51%. So there is stuff there. The key is, what is the pace going to be? I pulled this data up for you, and last year, Navarre was at 61% of its occupancy. 61% occupancy at the same time. So trailing a little bit behind. This trend of the occupancy kind of being under pressure that's been happening since February seems to be continuing into July. When we look into August, this year we're at 17.3. Last year we were at 23%. So a little bit wider trailing. So Navarre seems to be under quite a bit more pressure than Ookaloosa and Fort Walton. Finally, for September, not a ton on the books right now. We're at 6.3%, but last year, this time we were at 13%, so almost half down. It really indicates that this market's under pressure. The booking window is much shorter here, but also potentially that the market is not pricing well for the consumer out here, right? So already you can see, even just looking at some different markets in the Panhandle that are relatively close, we see slightly different trends. And so if you have owners that are talking to their friends and their friends own homes in other beaches, there could be very different situations, not to mention your own portfolio may be performing a little bit different. Now, let's just take a quick look at the highest performing listings, just to see if there's a difference in trend. For the most part, we're seeing things be about the same. Now, the May gap seems a little bit higher. We still see attrition in June. We still have a lot on the books in July, but there's quite a lot there to go. So overall, that pressure is being felt by kind of everyone in the market, whether you're a high performer or at the market average. Let's take a look at the asking rates. I have the asking rates pulled up, and again, we're looking at just last year and this year. And the main difference I'm seeing here is, Ookaloosa and Fort Walton, we're looking for pretty stable. While they were pushing rates a little bit, it was not very dramatic, especially when we looked at the top performing listings. We didn't see a dramatic difference in the rate position compared to where the market was posting these rates last year. When we look at Navarre, which seems to be under a little bit more pressure from the occupancy side, the thing that sticks out to me is from April, May, June, the rate positions are quite a bit higher. So the market doesn't seem to be responding super well to the fact that at the end of the day, the occupancy is under pressure, right? What that means is people are maybe holding because we're seeing really strong short booking windows. They're hoping that'll come in. But it does also mean that there's maybe an opportunity here. The market does not seem to be adjusting too much, even though there's a little bit of occupancy pressure. Now, granted, the occupancy pressure isn't high. A lot of people in the market probably are doing pretty good on their pacing. They're probably pretty comfortable with where they are. But if you are pacing behind, you might need to make some adjustments, and do those adjustments with the understanding that the market itself may be a little high for the consumer, right? The consumer is shopping around. They're looking at other market areas. And for you, you may not have to go all the way to where you were last year, but you do want to check where your price position is in relation to last year, so that you can kind of make some decisions about how you want to adjust. Now, same kind of trend that we saw in Ookaloosa and Fort Walton is that the August and on pricing is really not optimized to last year. Now, it's not too unoptimized because you do see that the rates are being pushed a little bit in June and July here, but there's pricing pretty high compared to last year, despite the fact that the market is down in occupancy. I think for you guys, this really does present an opportunity. If you spend a little bit of time putting your August, September, October rates in line, you can really start to take some of the market share. Now, I understand that those months aren't super high occupancy months. They're definitely not like June and July, but at the end of the day, they're not low either. It's essentially equivalent occupancy, maybe a little lower than the entire spring period. So there is a lot of space. And if you're like me, you've been hearing a lot of people actually talk about how well the falls have been doing, especially in relation to the spring. That means spending a little bit of time to focus on getting those rates in line, making them super competitive right now, putting them at a really reasonable rate could pay dividends because one, you can make up for any shortfalls that occurred earlier in the year. Two, if you're already ahead, you can really push the market share and do really well this year. I think this is going to be especially true because unlike in Fort Walton and Ookaloosa, Navarre is actually pacing behind for August and September, which means if you wait along with the rest of the market and the market is coming to the month pacing behind, it's going to be even harder to cut the rate because everyone else will be cutting too. If you cut a little bit now, you can potentially take that market share, not have to give up as much on rate, and also save yourself a little heartache from having to compete with everybody in these kind of stressful short booking windows that have been occurring this year. Now, the last thing I want to show you is kind of what's happening in the highest performing listings. And this is quite different than what we saw in Fort Walton and Ookaloosa. For one, those spring rates remained pretty high, probably contributed to the shortfalls here being bigger in Navarre. The market was really pushing those even at the highest end. We do see rates are still pushing a little bit in June and July, despite the fact that pacing is really on the edge, not quite, just slightly behind. But what you do see here is that strategy that I'm talking about is actually being enacted by these high-performing listings. At the market level, rates are remaining really high August through October. At the highest performing listings, they have already gone ahead and really put their rates in line with last year, made them super competitive in an effort to really drive the occupancy here before the rest of the market reacts. I think that that's really a good strategy. Questionable whether or not they might be pushing a little too much in the summer here, particularly because we're still seeing a little attrition. But this strategy overall, I think, is a really wise thing to do and can potentially take a year that is under pressure or more difficult than you want it to be and make it look really good by the end of the year. All right, guys, I hope you found that market data helpful as we're in the height of summer. Again, for both markets, my advice for the summer really is watch your pacing on a week-to-week basis. Make changes if you need to, but really focus on how every week in June, every week in August, and starting to take a look at September, how those weeks are selling every week for your whole portfolio and then for each group of listings. You really want to be on top of your pickup and compare that to the market, right? If you're pacing really well, you know that maybe, in Navarre, the market's under a little pressure. In Fort Walton, it's pretty much in line. That's going to help you make decisions about how much you need to cut. If you know the market is down and you're down, you're probably going to make a big cut. If you're way ahead, but the market's down, you might be willing to make a small cut or no cut at all, but you're definitely probably not going to raise the rate. Your own pace is going to be a big piece here, and you have to relate that to what you see going on in the market. For you, make sure you do it every week. Now, the second piece of advice is go put your pricing in a competitive place for the fall, right? If you have a shortfall, then you could potentially make up the occupancy and some of the revenue that was missed for earlier in the year. If you have to cut rates in the summer, it's another opportunity to make that up, especially if you have properties that are traditionally low occupancy in the fall. If you're ahead, it's just a way for you to get further ahead. Now, I've mentioned pace a lot. It's a really big component here. Knowing what's going on in the market is only half the story. You have to compare that to your own. Just a reminder, Wheelhouse has a fantastic tool for pace and business intelligence on your portfolio. Using Wheelhouse's performance analytics, you can see all the way down to the daily level a snapshot of your tape chart. You can filter this to any group of listing from your whole portfolio to just your 2 bedrooms to just your homes on a specific beach. And using this, you can identify exactly what days are selling, exactly what days are stalling and languishing. You can look and see how that's changing week to week, and you can even compare to where you were last year at a glance. With this tool, it's super easy to see, hey, last year, these dates, I was selling a lot and I was higher occupancy, and this year I'm just not selling them. Whereas on these dates, I'm right in line and I'm making sales right now. If you need a tool to see your pacing at a glance and you want some training on how to use this and incorporate this into your process, shoot us an email. We'd love to get you connected and help you make the best of the rest of the summer. Thanks and have a great day. Bye.